to you, Dom.
Fantastic. Well, look, morning everyone, and thanks for the opportunity to present today. Well, at least in the Peasley household, it's Christmas time. The tree's up, and it's up in Gary's house by the looks of it as well. Fire's lit, and although it's only sort of 9:30 in the morning, sort of feel free to pour yourself a nice glass of wine or at least a cup of coffee. And I think I'm just going to tell you a story. Now, all through the house, not a creature was stirring, not even a mouse. But then my phone rang and Ollie asked me to speak on the challenges around capital raising and growth, hiring choices, and the path to profitability. Not the catchiest of titles, but an interesting tale all the same. But let me firstly tell you a little bit about my checkered history and how I came to be, or sitting here today, I should say. Let's rewind quickly 25 years. I was an engineer by training, and for those of you who are any good at maths, you'll probably realize that when I graduated, it was right into the midst of a dot-com bust. So I ended up doing what every good engineer did and took a job with PwC and qualified as an accountant. But like many entrepreneurial people, got bored extremely easily, extremely quickly. And so I quit my accounting job, and after a brief stint in financial PR, and I'm not quite sure what I was thinking there, I ended up working in a structured credit hedge fund which specialized in US subprime mortgages. Now, I'll try and impart a few learnings as we go along, but rule one for today: don't invest all your money in a subprime mortgage hedge fund just before the market crash. I did, and in fact, I don't think I could have timed it worse, investing pretty much all the capital I had a week before the Bear Stearns fund issues. That was really the first time I lost a lot of money. But I went from there to work for Goldman in sales. I ran their UK fund distribution business, and there seemed to be a trend because I took the job, and this was on the Friday, and I was due to start on the Monday, and it was over that weekend that the entire banking system nearly collapsed. And that was the weekend when Warren Buffett stepped in and saved Goldman. But anyway, I realized that I like the challenge of building businesses, and I went on to build distribution franchises for a couple of other asset managers across the UK, Europe, Asia. But at the same time, there were a lot of fintech springing up. Yeah, this was the era of cheap money. The banks were still retrenching post-crisis, and the market seemed ripe for disintermediation. And I launched my first company, a fintech consulting business, where we would look to raise institutional capital from pension schemes and insurance companies for fintech lenders. Now, if I look back, I think, I was probably slightly arrogant at the time. I knew we were good. I knew what we'd done in the banks, and I thought that would translate straight away into a new company. And that brings me to the next lesson that I learned, which was when it comes to hiring, sometimes people who've worked in large organizations sometimes have an overinflated sense of self-achievement. And sometimes it's the brand that was sitting behind them that actually facilitates their success. People would always answer the call when you call from Goldman Sachs, not so much when it's an unknown company run by someone from Goldman Sachs. And we launched that business on a contingent fee model. So we would only get paid if we raised money. The advantage there was that gave us access to bigger clients who were willing to roll the dice. Frankly, it was no risk for them. They didn't have to pay us anything unless we delivered. Now, the theory was right, the timeline shockingly wrong. So it took us around 18 months longer than we originally thought to generate any meaningful revenue, by which point I'd burnt through all of my money again. So lesson 2 from me on that was make sure you get the pricing right on day one. If you've got a good product, don't underprice that or your time, because both end up being incredibly important. The clients that value what you're doing or the service you're providing will be willing to pay for it. But fast forward 5 years, that business runs really well now, but it does work on a retainer model as well as a contingent success fee model. But anyway, I went from there to work for a FinTech lender called Funding Circle. And my role was to take them from being a peer-to-peer lender, where you or I would invest part of our hard-earned ISA money into loans and turn them into an institutionally or 100% institutionally funded business. And at its peak, Funding Circle was lending around 3 billion a year. And we did that through a pandemic as well. So I saw the inner workings of the British Business Bank, BEIS, Treasury, as we fought to get alternative lenders access to be accredited under the government loan schemes. So the COVID schemes, coronavirus business interruption loan scheme, bounce back loans, and subsequently the recovery loan scheme. But it was clear that still with all those SMEs being funded, there were massive gaps in the market. And there are thousands of amazing growth companies engaged in innovation that sit between seed and Series D, and many of whom are either sitting on this call or listening to this presentation. And these companies are typically loss-making and in some cases pre-revenue. And no one had been mad enough to launch a lending business dedicated to this sector of the economy in the midst of a global pandemic. But as many of you will be aware, the majority of the companies at that stage, seed through Series C, D, they raise equity, they burn equity, they then raise some more equity, and then they burn some more equity, and some fly and others falter. But they all seem to have one thing in common, which are leadership teams that will do anything to help their business succeed and thrive, pretty much no matter what the challenges that they're facing are. So I started to burn through some capital myself, and we launched Sprk Capital behind the scenes in 2020-21 after a small seed round. And that enabled us to start building the technology that we needed for our tech-based lending platform. And the key here was staying focused while we were doing that within the business model. It's very easy to get distracted by nice shiny toys when you're building things out, go down different routes that you might not have been expected. But Sprk was built to do two things and just do them well. So we would lend against research and development tax credits, so helping SMEs access finance at any point during the financial year. And we'd provide drawdown facilities for companies that had been awarded grants but needed to fund those projects before the grant bodies paid out. So the focus and the entire focus of the business was to finance innovation in the UK, promote growth and stimulate employment. But after our seed round, it was clear that we needed more money to commercialize the business, and we thought about how we go around doing that. And we were probably quite fortunate that my business partners and I had been in financial markets for 20 plus odd years, and we had a large number of connections between us that we could lean on. And between us, we'd probably funded by debt and equity around 40 different platforms around the world, some with more success than others. And we ended up raising just shy of £3 million from about 40 different contacts across the UK. Now, that wasn't easy. Taking 2 to 3 million credit off one family office or one large investor would have been the easy route, and actually an option that we had at the time. But it was tough. I'm sure you're all familiar with this, doing the same presentation over and over and over again, traveling everywhere, and then you've got the timeline on top of that. What you think was going to take you 2 to 3 months ends up taking you 5 to 6 months. We ended up closing our funding round in October of last year after a pretty long slog. But the network effect that we found of having 40 different advocates across the UK meant that we had 40 people, each of which probably had 2 to 3 other investments on average, which meant that we instantly had inroads into 100, 200 growth stage companies, and those companies would then introduce us to more companies. So the lesson I took from that was that, look, it's not easy raising equity, and anyone on this call will realize that. But sometimes you do get an easier path offered to you when you're going down that route. But sometimes that's not the right one for the business. For us, it was stepping back and making that assessment. It was finding a way that we could leverage what we were doing from an equity raise perspective to create awareness of the business without spending vast amounts of money on marketing. And the route that we chose, going down this more diversified funding route, enabled us to do that. But that sort of got us to an interesting point, right? We had platform, we had money, but I had no staff. And sitting there in this little office at the time by yourself can be pretty demoralizing at times. But it does give you the opportunity to sit back and think. And I'd be thinking pretty carefully about who we'd hire and what we'd hire into the business. The one thing I probably would have done differently at this point is, by this point, we've probably spent 150, 200 grand on legal fees, just setting up the business, putting lending contracts in place. And, with hindsight, probably hire number one should have been an in-house lawyer, probably would have been cheaper. And I guarantee that anyone who's gone through the process of setting up a business and spending a load of money on legal fees will probably tell you the same. But for us, when you're running a tech platform, well, it sort of speaks for itself. The key thing is getting the tech right. And tech resource in London is, or definitely was, pretty hard to find. And one of the other dads at the school gate ran a specialist tech recruitment business, and we were fortunate to get a few candidates out of him that were put in front of us. But I'm sure, as you'll do, leverage those connections, and on the odd occasion ask for a favor, because people do like helping out businesses that are growing. One of those recruitment firms actually ended up becoming an investor in Sprk. But the problem with a startup is that it takes a certain type of individual to join it and to buy into the story. And I was fortunate with Ivan that he'd done his time in a growth company. He'd worked at places like Zoopla, but he's also worked at large institutions like Willis Towers Watson. But early employees are buying into one thing. They're buying into your vision as a leader. So being clear on this and how that person fits into the story was key. So I took a decision extremely early on that every single member of the Sprk team would have a percentage of their salary awarded as a bonus every year in equity. It was important to me that every single person in the company benefited from the growth of the business and was brought into the overall mission of what we were doing. And the next step was then to go out and look across the key roles, so heads of business development, operations. And it's very, very tempting to go out and hire a team of hungry graduates, train them up, relatively cheap, have a lower burn rate. But that's not what we did. We took the entire opposite approach. We ended up hiring senior, seasoned professionals out of decent sized firms that wanted to go on an entrepreneurial journey. And we ended up paying them market rates. We offered them benefits, healthcare. We, of course, gave them all equity. But the key for me was understanding at what point in their career and life journey they were actually on. So we offered flexibility in terms of base and a bonus, with the opportunity to either take a lower base and higher bonus, or vice versa. Because for some, the stability of salary was needed because they had mortgages, school fees to pay. But for others, they wanted the opportunity to strive for higher targets and be paid more. And that was their key driver. And as we fast forward to today, we run an extremely lean team. But we have people who know, and I suppose are known in the industry that we operate in, but who are prepared to work extremely hard. And frankly, for me, that is an absolute dream position to be in. And I'm extremely lucky to have secured the people we did. But the key learning I took was trust. You can't do everything, although you'll probably try, and probably everyone on this call has been in that point. Yeah, I needed to ensure that anyone that we were hiring into the business, those key individuals, were empowered to be able to make decisions in the best interest and on behalf of the company as well. So you're in the midst of starting a business. You're doing everything from setting up the payroll through to negotiating with your largest customers. And finding ways to delegate is really tough, but it's absolutely essential. And the other philosophy that we implemented from day one was the concept of radical candor. And for those of you who haven't read it, I think it's probably sitting on the shelf above me here. It is a fantastic read. It gives a very good framework for feedback and encourages upward and downward constructive feedback on a continuous basis. And you need that feedback from your staff when you're building the business. We did some simple things. So we, for example, implemented tools like Slack from day one, which meant that all of our internal conversations were kept off email, didn't clog up inboxes, and that way we could see client requests coming through more clearly, and we could be more responsive. And we operated a hybrid team. So post-pandemic, people's working styles have adapted. I'm still in the office 4 days a week, escaping 3 kids, 2 dogs, 3 cats, and usually a few stick insects running around the place. But for others, they come in between 2 and 4 days a week, depending on their personal situation. But we made the decision to have an office location which was extremely central, that everyone could get to easily. We've got people who live north of London, South End, west, on the south coast, and having that central hub was key because you need to be able to create a culture from day one. So I suppose with all that empowerment, do the team screw things up? Actually, not that often. It's usually me that screws things up more often than not. But I'm quite lucky that I've got a bunch of people that tell me when I'm doing that and help correct things. But I also know that I piss them all off at times, frankly. I'm acutely focused on this path to profitability, which means that I need to maintain a laser focus on the cost of the business as we scale. And the team know, or at least I sort of hope they know by now, that I keep pushing them until we're extremely stretched, at which point I give in and then I hire additional resource. Now, time will tell if I'm right there, but hiring ahead of growth is great if you've got tons of VC money to splash about and you're willing to roll the dice on everything landing the right way. But for me, I've seen fintech lenders get themselves into a lot of trouble scaling ahead of growth coming through. It also sometimes results in having to make some very tough redundancy decisions along the way. And that's not what I wanted to do. I wanted to give people that stability as we scale, especially when they're buying into a vision and they're buying into you as a leader and an individual. And we've been faced with some pretty massive market shifts over a short period of time. I mean, look back 9 months at what you could have secured your mortgage for, and now look at the rate. Now double or triple that and apply it to a lending book. That's the situation that some lenders have found themselves in with pretty large headcounts. So we'll always run lean, but we'll always hire the best people that we can afford. So staff sorted, platform sorted, operating capital, but we had no funding for loans. Small problem. R&D lending in the UK is a relatively new asset class. It's not like going out and getting a normal funding line for traditional lending. There's no real history on how these businesses will perform, and it's really hard for a lender to assess the risk because no one's really done it. We were fortunate that we were able to secure what turned out to be a £50 million financing facility from one UK asset manager who was willing not only to back a new asset class, but a new team. But I think the benefit that we had from hiring an experienced team on day one meant that it gave them a high degree of confidence that we could manage a lending business successfully. I mean, just to put this in context, we ended up speaking with 15 potential lenders. I think 11 of them said no, or that we were too early. We ended up going through a process with 4 of them and selected 1 to work with that we thought would be supportive of the business and some new products as we were going to scale the company. But the key here was also attracting and securing an attractive rate of funding. And that was critical for us because we knew there were other lenders in the market, and we knew there were people that wanted to try and come into the market, but none that probably had the growth plans and the ambitions that we did. So our cost of funding on day one meant that we were instantly more competitive than anyone else in the market. And that really, I suppose, validated that 5 months from when we closed that initial Series A, C plus, whatever you want to call it, in October 21, through to when we finally closed the funding facilities in sort of late Q1 2022. It meant that we would have sort of quite a healthy positive margin on every single loan that we wrote from day one. And yeah, when we've looked to launch new products, such as our grant funding program, we first found a client who wanted to borrow. We calculated how much potential income we could get off that, and then we tried to bring the legal costs and the product launch costs in for under that. And that way we knew that every single loan that we wrote after that on that program would be accretive to the bottom line. So as we finally sort of look at this path to profitability, the market's gone through, I suppose, so many stages of what's demanded from fintechs. But the key phrase that everyone seems to be banding around now is growth with profitability, and sort of, no shit, that's what everyone wants. It's like the holy grail. But for us, that means ramping the business, but focusing on quality over quantity, I suppose, is the best phrase. So maintaining for us a 0 loss rate from businesses on our lending, and being very selective is key to our growth. And it's really, really tempting to ramp up quickly. And that's usually the main discussion that we have at a board level and as a senior leadership group. But by controlling the burn rate, we're able to get to a level of cash flow break even earlier by writing a lower volume of larger, higher quality loans. And look, the market backdrop is tough for all startups at the moment. So for us, it was, how do we widen the opportunity set and then be more selective within it? And that means that we might not overshoot a budget, but that becomes a deliberate choice in the way that we ramp the company. And I think over the long term, I think that strategy will be successful, but we have to keep an acute eye on what's going on in the market and how our competitors are performing. And for me, that's the path to creating long-term value creation for our shareholders. So on that note, I seem to have rambled for about 25 minutes, and I think that's probably about my time. So I just want to say thank you very much for listening to me today. You're able to visit us at sprkcapital.co.uk, that's sprkcapital.co.uk, or follow us on LinkedIn. Hope you all enjoy the festive season and look forward to catching up with many of you over the coming months.
Dom, that was a fantastic insight and potted history and gave us some very, very good tips. Thank you very much for that. Has anyone got any questions for Dom while he's with us this morning?
Yeah, I've got one, and then we'll wait for others. But Dom, so I was just writing down a few things as we was going along. One is, you say you need technology. What's that technology for? Yeah, so that's one question, because obviously you're lending money. I don't know what your technology is. Also, I should imagine a lot of it's about learning who to actually give money to, that you know that you're going to get that money back, which makes you more money. Are you going to use that data? Like, have you got any previous data, or are you looking to use the data that you're getting now to go, these are the clients that we should go after to make that process easier?
Yeah, two great questions. Thanks, Gary. But from a tech perspective, what we need to provide, and what is key for small businesses as they're growing, is speed and certainty of finance. Now, certainty can come in two ways, right? Being able to give a no decision is just as important as being able to say yes, because I don't want to be, as a small business owner, hanging on for 2, 3, 4 weeks for someone to mess around in the background and then say, no, I'm not eligible for a loan. Thanks very much. Go somewhere else. Well, I could have been doing something in those 3 or 4 weeks and actually sorting my problem out somewhere else. So technology was key to us being able to process loans and process the volume of lending that we get come through. So we try to automate as much as we can. There's always going to be a manual input within this type of lending. We're dealing with quite esoteric businesses, but you can automate 80% of this. That means that from the moment that we get all the information, a company within 24 to 48 hours will have a yes or a no off us. And then they'll be funded within 24 to 48 hours from that. So we've been able to work with loss-making pre-revenue company that's approached us on a Friday and they've had money in their account by a Thursday. I don't think we could have done that without the massive investment that we put into technology in the background. Your second point on learnings, I think for us it's about creating a partnership approach. So we work with a tight number of R&D advisors, accountants in the market, grant advisors, and we keep that panel deliberately tight because we want to work with businesses in the long run. So creating a book of lending is great, but creating a partnership with those companies where we integrate ourselves into the cash flow of those companies going forward to give them more certainty is more important. So do we use the data? Yes, but is every company that's going through a startup scale-up phase different? Yes, they are. There are some commonalities and there are some things that we can use to filter out certain businesses, but part of that 20% that you can't automate is that discussion with the business, understanding what they're doing. And I always have one of the team, or indeed sometimes myself, speak with every single borrower that comes to Sprk because we want to understand them and we want to be part of their growth journey.
Thanks, Dominic. Any additional questions, guys? I think that's it. One thing I was going to point out, Dom, you may raise a point earlier about founders sitting in a room with lots of thinking time. And that's one of the primary reasons we set up Startup to Stand Up, to invite them founders into a safe and secure environment where they can exchange and help each other with ideas. Everyone's going through a similar journey. And when you get a group of, very creative and willing entrepreneurs in the room every week, it enables that creativity and the juice to flow a lot quicker, and solutions and ideas to grow as well. So if ever you want to come in and join us as a guest on one of our weekly Wednesday morning sessions, we'd love you along if you would like to come along and see what we do.
Fantastic.
All right.
Lovely.
All right then. Thanks, Graham. Thanks, Ben. Thanks, Peter. Have a great weekend. We're going to give you some love and some big ups on LinkedIn today, Dom.
Fantastic. I shall
appreciate this talk. All right.
Great. Thanks very much, everyone.
Thank you.
Cheers. Bye.
Bye.
That's great.